Hey everyone, it's Ryan. I have a pretty exciting video for you guys today. We're going to be talking about the differences between a traditional IUL and a high cash value IUL, in which we here at Enhanced Wealth call our enhanced asset. Now, there are a few differences when talking about a high cash value IUL and a traditional IUL. They are very, very, very different in terms of the way that they grow, the cost of the fees, the ways you can use them, all these different things. And so whenever you hear negative stories about an IUL, or whenever you hear stories about an IUL not producing the way that it should have, or that it lapsed, or that, the cost of insurance was too high, or that the fees were, all these different things, 99% of the time, it's from an IUL that is traditionally structured, not optimized for high cash value. Now, I have an example here, YouTube example, male, 40 years old, and I'm just going to show you exactly what the differences are when structuring this. The whole conversation is completely different. The reason why I say that is because with a traditional IUL structure, this is normally how the conversation goes. Okay, Mr. or Mrs. Client, how much money in death benefit do you want, right? And let's just say somebody were to just say $1 million, right? And so the financial professional puts in $1 million here for the death benefit, right? This is the death benefit right here, right? And then the next portion is that you're solving for how much that's going to cost you per month. Okay, so you want $1 million in death benefit. Let's find out how much per month that's going to cost you, right? And then they would calculate for that. And while this is loading up, I'm going to kind of talk a little bit how that's the wrong way to do it. Because most of the time, people want an IUL because they want the high cash value portions. They want to use it for infinite banking, or they want to use it as a high yield savings account. They want to use it as a college plan. They want to use it as a tax-free retirement tool. They want to use it for generational wealth. They want to use it as for a wealth accelerator. They want to create wealth, multiply their wealth, preserve their wealth, and transfer their wealth, right? Those are all the things that people want to use their IUL for. Well, this structure that I just did, asking you how much death benefit you want and solving for how much it's going to cost you per month, is wrong. That's not how you should do it. And here's the reason why. You see zeros here, which means you're not going to have any cash value in year 1 and in year 2. You don't start seeing cash value or surrender loans until year 3, right? So your cash value is $7,400 in year 1, $15,200 in year 2, $23,000 in year 3. So yeah, you're still getting cash value, but you don't have any access to take out loans until year 3. And then when you do get access, you only get access to $3,000. It's not until year 4 that you have access to $14,000. So not terrible, not absolutely terrible, but that's not the way that's not even the way that the conversation is supposed to be. If you're coming to me saying that you want to use your IUL to help you invest in real estate, to help you scale your real estate portfolio smarter, faster, and safer, then why would I ask you how much life insurance you want? The amount of life insurance you want is irrelevant, because you're not going into the IUL wanting it for death benefit. You want it as a foundational asset that then you can stack on top of, right? That's why you want it. So the structure should be a minimum non-max. So what this means is that I'm giving you the minimum amount of life insurance I can possibly give you while still keeping everything tax-free. Right now, the beauty of the IUL is the fact that you do have that life insurance, is the fact that you are underneath the umbrella of life insurance, because now you're protected under tax code 7702, right? And tax code 72E. Tax code 72E allows all the money inside the IUL to earn interest tax-free. Tax code 7702 allows you to take that money out of the IUL tax-free and penalty-free at any age, right? There's no 59 and a half rule with this. And so now instead of, and so to kind of touch on that even more, the minimum non-MEC, the MEC part just means not triggering taxes, right? You need to have a corresponding amount of death benefit to the amount of money that in which you're putting in, right? So a perfect example would be, instead of solving for this number, we're actually going to type it in, right? How much money do you want to put into the IUL, right? Now, it depends on what you're doing. If you're just saving for retirement, then maybe you might not be funding the IUL as aggressively as someone who wants to use it for real estate, right? So if I have somebody who wants to put money into real estate, let's say they want to put $30,000 a year into their IUL, and they're age 40, and they want to do this, for 15 years. They want to put $30,000 a year into their IUL for 15 years, right? And so we're going to change this from monthly to annually. And now what's going to happen is that this is going to calculate for this number, the death benefit. Based on a 40-year-old male putting in $30,000 a year, what is the smallest amount of death benefit we can possibly give them for that number? Now, the minimum non-MEC is going to be different for everybody. It's going to be different based on their age, based on if they're male or female, and based on whether or not you're putting in a lot of money or not a lot of money, right? Now, here at Enhanced Wealth, we normally gear towards higher net worth clientele, more so real estate investors, people who want to use their IUL to go ahead and purchase businesses or assets, gold, crypto, all these different things. But that doesn't mean that we don't help our clients who also just want to, throw in $100 a month for their 9-month-old baby because they want that money to be compounding their whole life and use it as a college plan. We absolutely still do that. Doesn't mean that, if you're 21 or something and you want to put in, $250 a month into your IUL to use as a supplemental retirement plan, yeah, we'll absolutely do that. I'm just saying that, we kind of hyper-focus on more so bigger fish, I guess you could say. But let's go ahead and calculate this really quick. And let's... I'm curious to see what this ends up projecting here. So let's go and scroll down here, click on this. And now we can see right away that things look quite a bit different. So as you can see, the death benefit number is lower. The death benefit number is lower, right? But check this out. Year 1, this was a 0. Year 2, this was a 0. Year 3, this was 3,000. Now it's 15,000, 45,000, and 77,000, and basically 150,000 in year 5 for loans. See the dramatic difference there? It's all just about what the conversation is. That's what it is. When you're sitting down with somebody, are they asking you how much life insurance you want? Or are they asking you how much money are you looking to fund into the IUL so that you're able to execute on the business deals you want to execute on, so that you can be saving as much as you want to save per year, so that you can be allocating the amount of money that you want to be allocating towards your retirement every year, so that you could be hitting those goals in terms of how much you want to be putting away per year for your child's college fund. That's the main thing. And that's why the structure of the policy is so crucial, right? Now, this is an extremely healthy policy. Now, I can go as far as I want, right? Look, now we're in year 16. No more money is being funded into this policy for the rest of the life of the policy. Remember this, right? The $450,000 has been put into this policy. And you can see that after every 5 years, that number is still the same. No more money has gone into this policy at all. But notice how the cash value just keeps getting larger and larger and larger and larger. And your line of credit continues to keep getting larger and larger and larger and larger. And because the cash value is continuing to get bigger because you're continuing to earn interest on your money every single year, well, the minimum non-MAC death benefit gets a little bit bigger every year too. Because keep in mind that the amount of death benefit you have is corresponding to the amount of money you have in the policy. Well, every year the policy's earning interest, which means more money is in the policy, which means there's a new calculated minimum non-MAC death benefit every year, right? And so I always hear these things that's like, oh, wait until later in the life of the policy when the cost of insurance becomes so high that it eats up all the cash value. Where? Show me where. Because when you properly structure these policies, the cash value is just continuing to gain larger and larger and larger and larger, right? Runs all the way until year 120. Look at this. 4 million, 5 million, 6 million, 7 million, 8 million, 9 million, 10 million, 12 million, 15 million, 16 million, 18 million, $20 million. All right, it's still going. 22 million, 25 million, 26 million, $28 million. So, more than likely you will not live until age 120, but you've turned $450,000 into $28 million in cash value, which is literally, think of like your high yield savings account balance inside of your IUL. You could also take out $28 million worth of loans, and your family get paid out a $28 million death benefit. So, yes, in fact, it depends on the IUL and it depends on the life insurance company. But with the companies that I write with and with the policies that I structure, my clients get the cash value and the death benefit, not just one or the other. And I would not recommend that anyone ever gets into a policy that only gives you one, because that sucks. So let's look at like a more realistic year. Let's just say you kick the can at 100, right? That's pretty realistic. You've put in 450. You've turned 450,000 into $8.7 million tax-free with zero market risk. Come on now, guys. But yeah, I mean, I just wanted to show that the difference between how much of a difference there is between just a traditionally structured IUL and a high cash value IUL, because there is a massive, massive difference between the two. And I don't want people to see comments or to see reaction videos or to see, comments from a financial advisor, right, who is saying that, oh, an IUL is bad because of XYZ reasons, even though they have no idea what they're talking about, right? They don't know any of the context. How is the policy structured? How does this guy on social media, how does he structure his policies? Well, the individual has no clue, but they're still commenting things, right? And so I just wanted to clear that up, because I've gotten that question a few times. What really is the difference between a traditionally structured IUL and a high cash value, or a max funded policy, or a minimum non-MAC policy, right? Different people on social media kind of call it a different name. I just call it a high cash value. You're structuring it specifically to get high cash value out of it, not for the death benefit. Hope that answers your guys' questions. If you would like to go ahead and learn more, see what your numbers look like, your age, your gender, your amount of money, your structure in terms of whether it's for a college plan, infinite banking, becoming your own bank, generational wealth, whatever the structure may be, go ahead and use the link in the description below this video to book some time with us so that we can run you through some numbers. And if it makes sense, then, obviously here at Enhanced Wealth, if it makes sense, then, we may be able to help you actually get placed into a properly structured IUL. With that being said, thank you for watching the video, and until next time.